Hello everyone. Welcome to this Friday webinar. My name is Kamal Manocha. I represent PMS AIF World. We have been doing, webinars every Friday with a fund manager with different perspectives. At times we have discussed big picture, equity as an asset class, and we know it has delivered over last 3 years very handsomely. We have been testing our conviction by presenting, many beautiful data points that were kind of discussed with various fund managers. Today's webinar in that entire, I would say, rhythm is being organized with Mr. Bhavin Shah. Is one because Bhavin is a rule-based investor. He's a mathematician, and his understanding of market is kind of, I would say, actually unbiased. He's somebody who would kind of put his heart and sentiments aside and would want to invest with logic, and that is what is makes him very different. He has more than 5 years of track record, has delivered stellar numbers. All of us know that. I do not want to discuss about what has been the historical return, because it has been delivering massive alpha and is one of the products that we had actually liked a lot, and we still have a great conviction for because of its process, as well as because it's alpha focused investing style. However, we know over last 6-7 months markets have been very distorted. There have been certain segments of markets which actually have become very euphoric. Some segments have actually not performed. And in that entire, I would say, time period, Sameeksha Capital has also seen underperformance. And that underperformance is absolutely understandable, and we acknowledge that. And Bhavin also, I'm sure, will acknowledge that. So this webinar is particular to understand from Bhavin, what is his understanding and how does he read, because he himself is also an investor in that strategy. And I think he's the largest investor because skin in the game is very high. So welcome, Bhavin. I have set the context for you. We want you to address without I giving any bias to it. I also want to understand, because I am equally from my investor's point of view keen to understand from you, what is your, I would say, understanding of what has happened over last 1 year, and where we stand today. And then obviously from here onwards we'll move on. Then I'll have further questions and answers, that those questions which have been given to me by my clients and what I have on my mind. If you have any data, any presentation, you're happy to share that.
Sure. Let me start by saying, thank you everyone for joining this webinar. We hope to, talk about what has happened, with our strategy over last year, and also over a longer period, how have, similar situations arose, and, what happened post that. First thing I would say is that, we believe in investing based on certain framework. That framework pushes us to invest in companies which are valued reasonably. I think as in a particular period of the market, it does become more difficult to find such companies. But that is not going to be an excuse for underperformance at any given time, because we believe that Indian market, and I continue to believe that Indian equities remains a very fertile ground for stock picking. So I think it is always a matter of trying to find the right spaces and the right names in a vast space of Indian equities. There are literally several hundred companies, that would be in an investment universe of a fund like ours. We have the advantage of not being too large, so that's why we can go down the market cap curve and look for smaller companies also, apart from investing in a very large companies as well. So I think there have been, first and foremost, I would say is that there have been number of opportunities even during this period where, some of the segments of the market and sectors have kind of, gone into very much a euphoric mode. Obviously there have been a lot of reports being published on, number of companies trading at more than 100 P multiples, and, how the current market cap of companies in many sectors, could not be justified even after assuming very bullish long-term forecast. But despite that, given our size, there are opportunities to be found in the market, and that is what we continue to work on. We continue to invest aggressively in our capabilities, both on the technology side as well as research side. And I think the importance of technology comes in because as the number of companies continue to expand in terms of the investable universe in this market, it does become harder to stay on top of that larger universe. And so how we can use technology to help us narrow down the right companies to work on, because every company that we decide to invest, we won't go through a very detailed process to invest, and it takes time. So if that time is within that time, if we are not looking at something else which is perhaps even better, then we might miss out on opportunities. And that's why we're trying to use the technology, and I think that will continue to be our journey in future as well. And I think we expect some interesting, far more interesting additions to our capabilities because of that in coming months. And hopefully it will help us narrow down the names from the universe. Now let me just share some slides to kind of discuss what has happened. Let me just go here. So I think my screen should be visible now. Yeah, so let me just do a slideshow. Yeah. So I think this is sort of snapshot of our performance. And I think while we have had amazing March 24, the current year we are slightly below the benchmark, and on a calendar year basis also we are below the benchmark. This is all on aggregate basis, not on individual client basis. So I think there is that gap that is pretty clear, and I think that's where some of the discussion can take place on what happened. And it's clearly the case that we haven't participated in some of the sectors that have moved very strongly in recent periods, whether it's the defense or some capital goods related companies and so on and so forth. And I think those stocks have moved from being, many of those stocks have moved from being kind of richly valued to extremely richly valued. And so, we haven't really participated in that kind of a situation. Obviously there is one interesting characteristics of our performance, which I think is visible at the bottom right of this table, of this page. The upside capture ratio, what percentage of up market do we capture over the last 5 years versus the downside capture. And we have had significantly low downside capture versus our upside capture being slightly better than the market. So I think in the sense that the way we invest, we probably have a better, significantly better performance in a down market relative to up market. I think, and obviously, the kind of rally that we have had post the state election results, we have not been fully participating in that. So I think if I now dissect that further into months, I think really it reflects what is apparent is that there was a big rally in the market in the months of November and December. I think that state election results, which gave BJP very strong majority, I think basically market started to price in the return of NDA, in the 2024 elections, and that strong rally. And versus that, if you look at our portfolio cash levels, starting from September 23, and those were, I think, perhaps because of the valuation richness that we had already seen, that we had a little bit of higher level of cash, and then so we had exited some positions, and in the meanwhile we still were trying to identify new ideas to participate in. And so, we for example, as you can see from this in December, we started the month with a pretty high cash levels, and there was a material underperformance in that month. And I think, then there was further underperformance in the month of March. Now, if I take that further into, new accounts versus tenured accounts, in other words, the older accounts. Now, we have always stated in our discussion with prospect investors that we don't follow a model portfolio approach. For every account, we look at what is worth buying today based on our framework, and we invest in those names which are still which are worth buying today. So it does happen that cash is deployed gradually in new accounts, especially when opportunities are fewer to find in a market. Now, while that is happening, if market rallies very strongly, as was the case with November 23 and December 23, that new account portfolio will not participate in the market. If you notice here, in November 23, new accounts on average had 43% in equities, 57% cash, compared to the aggregate portfolio, which was 83% invested, and tenured accounts had more like 86% invested. Now, BSE return, our benchmark return for that month was 7%. The tenured accounts, had 9%, so they still had outperformance in that month. But the new accounts underperformed because of significant cash level. However, if you look at the invested portion of the new accounts, it did much better than the index. So in other words, we picked the right stocks, but we didn't deploy enough capital for new accounts. And that's the nature of the way we invest. The sharp performance that, that we, our strategy of gradual deployment, may not work when there is a very sharp rally in the market. The question is, did we miss deploying the money aggressively, at that period? And the answer is yes. I think we could have been more aggressive because one of the things we also do is look at number of market indicators, not just the traditional price earnings multiples that everybody looks at, but also other proprietary indicators of valuation that take into account the profitability of companies, return on equity, and interest rates, and so on and so forth. And on that basis, the market actually looked quite okay, sort of in October 23 timeframe. So I would say that this was an error in our strategy of not being aggressive in deploying capital in new accounts, and I think that obviously hurt us. Hurt the performance for the new accounts in November, and then obviously in December also. Again, you look at the invested portion did quite okay, but because of the higher cash level, the overall portfolio performance for the new accounts was quite low. At the same time, now if you look at the longer term performance for the aggregate portfolio and the tenured accounts, there is obviously a significant alpha over time. So we believe that our strategy of gradual deployment has its drawback when market moves up very fast, and we have not taken that call to deploy aggressively. But over time, hopefully, we'll find more ideas to deploy capital at a more attractive levels, and I think hopefully we can compensate for that underperformance. I think what the market has been on an up move since October 23. There was a rally, obviously, post the state election results. And then I think, despite the NDA, not getting full majority, market has continued to rally. And I think there is obviously lots of warning bells that have been, rung recently about excessive valuations in the market. Now, if you look at some past performance that we have, we had some periods of underperformance. There was a period from October 17 to December 18 where the small and mid cap market got massively derated, and we had underperformance in that period. But I think if you look at the period post that, we were able to see a very good outperformance. Similarly, the calendar year 22. We had meaningful underperformance also, and but there was a very strong outperformance in the period post that. So whenever something like this happens, we want to look at the what is not working for us, what are we missing, and try to kind of compensate for that, hopefully over time, or maybe the stocks that we have invested eventually participate because of their strong fundamentals. The other thing I want to point out is that if you look at the market today, clearly there are lots of stocks with very rich valuations, but our portfolio valuation is quite reasonable. On a FY24, the trailing basis, our PE is only 18, and price to book is only 3.3. FY25 basis, where our portfolio PE is only 15.5. Now, I think if you compare this to many other portfolios, I think you would find that this is a very this portfolio valuation is very conservative. It doesn't show excessive valuation by any stretch of imagination. So we hope that this sort of positioning will eventually help us. Because these stocks are valued reasonably compared to their potential, and hopefully they deliver the results that that we hope to from them. Some of the stock, sectors that have been very strong, and I think we have been somewhat underweight. The defense, realty, auto, PSU bank. We haven't had much participation in the sector, and I think that's where it is. And I think sometimes what happens is, as I said, some sectors start with a rich valuation and go even richer. So those are not the places where we can that fit our investing style. So yeah, I think I would Kamal, be happy to take take any question you wanted to raise. I think I don't know where Kamal is, but I see some questions in the chat, so I'll try to address those. I think the question is, do I foresee time-wise consolidation market for next year or so? I think it's entirely possible. And I think market is at a risk of a correction on some meaningful bad news as well, or some time-wise correction on an overall basis is required, to basically align the valuation with the growth prospects. I think Kamal is back, so yeah.
Yeah, I think there was some technical issue at my end. Sorry for the little inconvenience. I was just going through all your slides that you are presenting, and you have dissected what went over last 6 months. And absolutely, I understand that it has happened in the past also, because we have also studied your data. I know we have given you awards for your outperformance in last 3 years and 5 years in association with IIM Ahmedabad, and we have studied your data. I know there have been periods in the past also where there has been underperformance, but then followed by that were periods of massive outperformance, and that is exactly what we expect and what we would expect even maybe over next couple of years. However, because future is uncertain, I want to understand from you, how do you think, in the current context, based on your past experience of kind of how you have seen in the past also, that underperformance got converted into outperformance. So what are the drivers of that? In your in your portfolio, there would be certain businesses which are yet to show turnaround, or you understand, like you are presenting, that market is relatively ahead of valuations and your portfolio is relatively better placed. And in the downturn of markets, your portfolios in the past have shown relatively superior performance. So what can be expected in this context? I know you are somebody who is not going to talk any story, because absolutely future is uncertain, but still, as a fund manager, we want to understand from you, how will this underperformance actually get transformed into outperformance in future?
So, what I can talk about is what process we follow, what do we do every day. We look at what we own. We have a view on every stock that we own is in terms of, how the business is going, what are the growth prospects, what is the upside that we see in the stock, what are the risk factors. And we try and continuously assess that. We review our entire portfolio in detail on a monthly basis as well. And if some name is something is not going right with that name, we would obviously try to exit. If things are going right, but the performance has not come through, then we would just have to be patient with it. So that is what we do, and we will do that for every single name in the portfolio. At the same time, we are spending a lot of time looking at new ideas. The names that are still might be still available at the right price, and where it fits our investment criteria, and where as a result, upside potential is there. And we'll see if something fits our criteria, we'll try to invest in those names as well, from the cash that we have, or if there is something that we are exiting from the portfolio. So that is a continuous process that we are following, and I think we believe that it will eventually bear fruit, is what I can say.
Sure, Bhavin. So, I'm sure you are aware of, what is the current market valuation, risk inbuilt in that, in line with the kind of corporate earnings that, have been coming. Are you comfortable, because if the corporate results, the way they are coming, are actually above expectations, then these valuations can sustain. Otherwise, obviously, this is one parameter which is mathematically going to be risky. I'm sure you would have tracked quarterly results. So what are your views in that regards? I want you to cover in general and then obviously specific to your portfolio.
I think quarterly results that are coming are kind of a mixed bag so far, on an overall basis. I think we're still at the early part of the result cycle, so a large number of our companies are yet to report. But the ones that have reported, I think so far we haven't seen any howler in the performance. And that is, I think, perhaps also reflected in the nature of our portfolio, that we haven't gone into names which were maybe flying high, growing at a very rapid rate, and some of them, like for example, some companies in the power sector reported results that are very disappointing, and then obviously seeing sharp correction in those stocks as a result of that. So we haven't, for the companies that have reported results, and my guess is maybe only about 15-20% of the names in our portfolio have reported results. We haven't seen any major disappointment so far. And I think in one or two cases, we have also seen a positive surprise. Although market is not yet right now, rewarding the stocks for that, because there is a little bit of that question mark about the outlook that investors may be having in the coming months.
Sure, Bhavin. So you also mentioned that you had actually missed and did not invest into stocks from sectors like defense, railways, PSUs in 2023 when these stocks are flying. But these stocks were kind of though at that time value picks, and you follow value investing. So what was the reason that you missed these stocks?
We have it's ironical that we were very early in investing into railway stocks in particular. Defense, somehow we haven't really participated. Railway stocks, we had some exposure early on, and maybe almost like 4 years back, and those stocks did not deliver performance for a very long time, and that's when we exited. And after we exited, sometime later, this big rally started. What was the reason for not investing them in them again? I mean, I don't think I can give any any strong justification, except that perhaps once beaten, twice shy kind of experience. That not having done well in the PSU segment, we were a little cautious, in our approach to that space. I think and I think sometimes there are no good excuses. I think the issue is always going to be that there are a large number of companies to evaluate, and where do we spend our energy on, and where do we spend our energy on, how do we how do we conclude? And I think some of these names required one. So one thing I would say is that when we were looking at the stocks in 2023, we had this uncertainty with 24 election, that which government will come in power, and we perhaps didn't want to go too far ahead of ourselves, because the way in which they were while they were in order to make money from those names, one required to believe that there is going to be a multi-year growth story, and whether or not the plans that they have, or they're talking about, whether they will continue post 24 election, there was that uncertainty, and we didn't want to build that too far ahead of the results, but the rest of the market did, and by the time we realized, we thought that the election outcome looks reasonably certain, it was too late perhaps to get into those names. The ironical thing is that despite subpar mandate, we have seen further rally in those stocks, and I think that is perhaps reflective of the nature of the market today.
Sure, Bhavin, let's talk now future. I know your skill set amongst various sectors. One of the sectors is IT, because come from that tech background, and we know over last 3 years, 2.5 years, IT has underperformed. It's very recent. It's like 1 week ago we saw some kind of position build up happening in IT stocks. So what are your views in this regards? Do you think that IT as a sector has bottomed out? You have also added few stocks in your portfolio lately, or you are already holding certain percentage, or you want to increase the weightage now? What are your views in this regards?
I think there is a relative trade that is happening in IT. What I feel that IT, relative to what has happened in the market, IT stocks are attractively valued, on a relative basis, I'm saying. And even the slightest positive news is getting grossly amplified by the market. And I'm a little careful about, chasing that. We have some exposure, definitely. Smaller companies, we believe, have a easier opportunity to grow, deliver, reasonable, meaningful growth, double-digit growth. For very large cap IT companies, it's going to be challenging to grow double-digit rates. So we will be, we would keep evaluating that and see if there is a reason to increase the weightage in that sector. But it will be purely based on it fitting our criteria. I think we haven't significantly. I mean, what we have is what we have. We haven't increased that weightage in a recent week or 2 weeks, so to speak.
Sure. In the same rhythm, if you can give maybe 2 minutes perspective on what are your views with regards to the financial services sector, because financial services sector is also something which has actually not performed much over the last 3 years, though some PSU banks have, but overall the sector has underperformed.
So sector has it has not performed as well as some of the what we are seeing in many of the other sectors with a very high returns. But I think we like the space. We think there are some very high quality businesses that can deliver healthy growth and are available at an attractive valuations, and so we continue to own that sector, and we hope that eventually market the performance will catch up in that space. So that is how we look at that sector, and we continue to like the financial space.
Sure. One more question, which one of my clients has asked. All of us know that you have a very high skin in the game in terms of your own investment, also similar to Sameeksha's portfolio. So when investors who have come and invested in last 6-8 months, and this unfortunate has happened to them, that last 6-8 months has been kind of underperformance for them. They want to know, have you also faced the same pain in your personal portfolio, or your portfolio is different than the clients who have come recently?
So my portfolio is, wouldn't be any different from any of the clients who have been around for us for a longer period, say more than, my guess is more than 12 months, 18 months, because the new portfolios will converge with old portfolios over time. So in fact, if you open up my portfolio with a portfolio of a client who has been around for 3 years, it will look very similar in terms of percentage weights in the stock. So what has happened to rest of the investors, obviously happens to my portfolio as well. And but that is, I think, to be honest, I don't want to make a kind of a big deal about it. I mean, yes, there is a commitment, there is an alignment, but that it goes only that far. Ultimately, we are here to deliver performance, and that's what we have to go back and work on.
Sure, Bhavin. So, at this juncture today, we have seen maybe markets have shown some correction before budget. So maybe if you could spend some time on what is your understanding of what is happening in the market at present, and if you have to give maybe a short-term commentary, though obviously it is very difficult to kind of predict that, but because you are an investor yourself, and it is very difficult for an investor to not have a short-term perspective on mind, especially when markets have run up so much, because there are certain clients who are sitting on cash and they're wanting to now at least not come at the peak. I'm not talking about investors wanting to book profits, because booking profit is something which is like not at all easy. But at least those investors who have missed the bus, they may not be coming at peak. So how do you see? I know you are somebody who's a long-term investor. Maybe you would be investing at these levels also if you are sitting on liquidity. But how would you see current markets from this point of view?
So I think the challenge for us is that we are Indian economy overall continues to look very strong. I think government is very growth focused, and I think they have a lot of levers to play. Tax revenues have been very strong. So I think they can steer. They have the ability to steer the economy, and I think so. With that kind of backdrop, we can expect reasonable corporate earnings growth, and as a result, I don't want to take I think notwithstanding what is happening with the valuations in some segments of the market, it is difficult to paint an overly pessimistic picture of the market. I admit that if for any if there is any negative macro development at an India level or a global level, the correction will there will be there can be a sharp correction. But from a longer term perspective, it is difficult. We have to stay constructive. Stay positive about the potential for this market. Is what I would say. I think how the current excesses get corrected, is a big question, and whether it's going to be just over time or there'll be sharp correction in some sectors. I think that we'll have to see. That I think is a question that everybody would have. But I think it is difficult to invest based on that. Obviously, the best thing to do is to not invest in any such names. And I think I showed that our portfolio P multiple and price to book multiple and return on equity, on those bases, we don't have a frothy portfolio in that sense. Does it mean that we won't be affected by the correction? The answer is yes. We will also be affected by any sharp correction in the market. But hopefully, those names have a less to fall than some of the high flying names.
Sure, Bhavin. I have seen over my last 2 decades of experience, a good fund manager or a good investor during the bad phase or a difficult phase actually sharpens its strategy, and when the tide turns, comes out in such a way that the underperformance actually becomes outperformance. And I really hope and wish that the same thing will happen with you. But I want to understand, during these last 6 months, while one, that you have kind of missed certain sectors and you acknowledge them, but at the same time, based on your learnings, have you done any changes also in your portfolio, in your strategy, in your process, in your approach, which kind of now makes you more confident? And investors who may not have invested till now, and because ultimately investors are, I would say, prone to recency bias. So they kind of, instead of they did not invest in the past, and now seeing the underperformance in the last 6 months, they may take a back seat. But this could be the best time, ideally, to invest in your strategy, because you have had learnings and now you are ready to actually outperform. So I want to ask this question from their point of view, because those investors should ideally understand what's going on.
So what, I think I alluded to the fact that there is a large universe of companies to look at, and that universe continues to expand as we see new listings. So one of the and we have over last 8.5 years, done a lot of work on maybe close to 300 plus companies already, and then we are adding more companies to that list. How do we stay on top of those 300 plus companies where we already have done detailed work in the past? So we have a very good understanding of the business. Maybe there is a new growth spurt in that company. Maybe the valuation has become attractive for some reason. How do we make sure that we don't miss such opportunities? Because those are the easier ones for us to grab. So we are trying to put in place some systems, so that we are able to grab those more easily. The other thing that happens in the market is, that from time to time, there is new there is some for some period there might be very strong momentum in particular sector because of the fundamentals, and I'm not talking about purely momentum. What do we do to kind of identify that reasonably early, so that we are devoting our energy more towards that sector, apart from doing kind of a broad-based bottom-up stock picking? So we are, we kind of trying to also put in place something around that as well. And I think those are, so basically taking a step back and thinking about how do we improve our stock picking ability, in this market. That is what we are focused on.
Sure, Bhavin. I'm just trying to check, if there's anything in the chat which I have missed. Yeah, one of the clients has asked that the current portfolio of Sameeksha looks to be having 30 plus stocks. So is this over diversified or is this by design?
So it is by design, because what we do is, for the percentage position we take in a stock is dependent on the liquidity in the name. So if the liquidity is, and we don't, because we don't want to buy the stock and have a big impact on the price. So we want, if you're buying in the market, we will restrict our volume in the market in that stock also. So that means that a lot of smaller cap companies, we will have smaller positions, 2%, 3%, and so on. If it's a very large cap and liquid name, then we can have a much larger position. But because of this position size limitation that we have, or criteria that we have as a risk management strategy, we end up, we need to have a slightly more number of names in the portfolio, and that is what we are working with.
Sure. Without maybe getting into the detailed answer, if you could give maybe a very short answer to this question, which is a common question of many investors currently, is, in your view, is it better to sit on cash or invest at these levels if one has a 5-year horizon in your strategy?
Having seen this recent underperformance, I think I'm sure investors would have, a lot of questions on whether if based on what I say. But I continue to believe that Indian equities is a great asset class to own. whatever money that we get, we believe in deploying it at a pace that is commensurate with where the market is today. So in this kind of market, we are going to be gradual in deploying new capital. Obviously, no matter that, if immediately after somebody starts to invest, or we start to invest for someone, if there is a big correction in the market, that impact cannot be avoided. But from a 5-year perspective, I am a big believer in Indian equities, and so we would continue to suggest that people think of that way. Plus, we also offer systematic transfer plan option. So if someone wants to put in a place investment plan with us, whereby we only take a small chunk of the portfolio into consideration for investing immediately, and then more on a gradual basis, that is also possible.
Sure. There's another question that has come on chat box. I'm just reading the same. Stock selection by Sameeksha is based on fundamentals. Why can't there also be some portion of the momentum stock portfolio? If your stock is, if your approach is conservative, your returns will also be conservative.
I think, if first of all, we do what we understand how to do, and it has served us well over this many years. I don't have anything against momentum stock if it is available at the right value. If we understand what the story is about, we think there is a good potential in that business in order to deliver the required growth to justify the expected appreciation that we would want from any investment. But in general, a lot of momentum stocks, can move from being somewhat richly valued to somewhat very richly valued rather, and that won't we would not be able to invest in those. And I think it is Indian. I believe in Indian equities as a overall asset class, where there are so many there are so many sectors and opportunities that if one is patient and works hard, one can find the opportunity that meets the framework that one is following. So that is what we continue. At the same time, what I would also say is that we are not averse to having a small part of the portfolio in companies which are sort of mispriced relative to their intrinsic value. They may not necessarily have a great growth story for a multi-year, but there may be just genuine mispricing. And though we would have some positions in a small part of the portfolio there as well. So, but pure momentum, I think something that it's not something we have a great expertise on, and we wouldn't want to venture into it.
Sure, Bhavin. Over last 5-6 years of your public money management in Sameeksha Capital, I have seen your weightage in large caps has been around 20 to 25-30%, and small caps is like 50 to 60%. In the current context, for new clients, are you going to maintain the same, or you think you will be changing this because small caps are relatively much expensive if compared to large caps?
So I know we have been thinking about this question a fair bit, and just because small caps overall have done well, it is not a reason why we don't want to invest. We don't want to invest. I've seen that quality of small cap stocks available to invest has improved over time, and I think so. If we find a good small cap opportunity, we would still consider investing in that. We follow 2-3 important rules. One I already mentioned, which is position size for an individual name. So depending on the liquidity in the stock, our position will be small. So and then on an overall portfolio basis, our ability to liquidate a portion of the portfolio very, very quickly if it is required. So there will always be a large cap. In fact, current large cap exposure is 30%. If it's a new account, my guess is that it will be slightly more tilted towards the large cap, and the percentage in small cap would be lower than the existing account, just because the number of small cap that are still available at the right price may be lower at this moment. But I think that is so that is what will happen with the new account in that sense.
Any particular sector you look to be heavyweight on as you keep your faith in Indian equities?
See, I think we talked about financials. We continue to like, financials is a very wide space. There is banks, there are NBFCs, there is insurance, wealth management. It's a very, very wide space. And so, and it's, even in a developed market, it is always, even say, if you look at the US market, financials are an important part of the market even today, even though tech has really been very dominant of late. And I think as India grows, the financial sector will continue to be very important, part of the market over time. So we'll remain, that will remain an important, very important segment for us. And outside of that, I mean, we're clearly overweight aviation. So, in segments where we see strong market structure, industry structure, which, consolidated industry, but with a growth opportunity, that's where profit pool is going to be richer. And, so that's why I mentioned aviation being one example of that. And I think we can see that, if we find some other niche, we would also do that. I mean, I think I don't have a very strong view on any other sector today. I mean, I think there are sectors which have, like, for example, the whole agrochemical space had, not done much for a while, starting to show some sort of positive signs. So maybe we would try to find something there if it meets our criteria.
Sure, Bhavin. I know besides PMS, you also have an AIF. Are you also, studying or evaluating the pre-IPO space or the late stage equity space in the unlisted market? And what are your views in that regards? Because there are a lot of funds which are today available in the market, which are catering to that particular universe, and they are claiming that because listed space is like quite expensive, in the unlisted space one can still get better valuations and one can make relatively higher return with a similar risk. But obviously there is a risk of illiquidity. But for HNI clients, they are ready to take that risk of illiquidity if they know they're entering at a lower valuation and they can get a better, I would say, 5-bagger or a multi-bagger kind of an opportunity. Do you also believe the same? Because you are an investor yourself. I'm sure you are managing your own money, also keeping all these things and possibilities in mind. And how are you applying that to your AIF as well?
So I think I'll divide that answer into two parts. One is that I have been I've been in equities market since 1996. So it's almost 30 years now. I don't think I've ever seen a situation where valuations are high in a public market but low in private market. They tend to go in parallel. When there is rich, valuations in public market, same thing happens in private market. Because when people sit across the table and they're trying to do a comparable valuation, they obviously going to use the public market names and try to price the companies which are late stage, pre-IPO stage and so on. So I think, first of all, we want to get that notion out of the window that, because, that public market is expensive, private market is attractive. That won't happen. Second, in AIF, we do have an option to invest in pre-IPO companies. And, we would want to participate in something which looks very robust and very certain in terms of IPO possibility. Because, our AIF is an open-ended AIF, which means that we provide entry and exit. And, when you have an unlisted company, how do you do the pricing of how do you value that, in giving an entry to a new investor or giving an exit to an old investor? So, it can become a tricky situation if, so that's why we want to, do it only when we feel that something is really close to an IPO stage. So, and if we find some opportunity like that, we would definitely participate. But it is going to be very, very selective.
So coming back to the, topic of, what to kind of see ahead in Sameeksha's PMS, we have last 10 minutes in this webinar, and I want you to kind of tell us, hand on your heart, what guidance you want to give to clients in terms of what returns they can expect. Say if they give you 3 years, investors who came 6 months ago, they had come with the horizon of 5 years, but obviously, because of last 6 months of relative underperformance, their horizon has shortened to 3 years, and that's how human mind works. Now, over the next 6 months or 1 year, obviously, if performance is like up and beyond their expectation, their horizon will increase. This is exactly how investors behave. But you keep in mind that investor who came 6 months ago, and now you have 2.5 more years from his inception, which is like say December of 2023, and 3 years from there. What is the expected return that you think? Again, I'm saying with a disclaimer that hand on your heart.
I think it's a very tough question to answer. I mean, I think so. First of all, the returns are a function of the market. So Indian market returns, and obviously the starting point always matters. All I can say is that when the companies that we invest in, we have an expectation of minimum return of 20% to as high as 20% annualized return at the time that we invest. 12% for large, liquid, safe name. 20% for more of a smaller cap, illiquid, higher risk names. So that is how we are investing, and that is perhaps that nothing is that approach hasn't changed, and hopefully if we find enough opportunities like that, we would be able to deliver at least the low to mid teens kind of return over a longer period of time.
You think your approach requires any kind of rediscovery or reevaluation to be able to align itself to the current complexity of market, whereby, as one of the clients had asked about momentum investing, which you said that you only do what you understand, which is absolutely right and understandable. But do you think based on whatever last 6 months of underperformance has given you pain as well? I'm sure somebody who has always been performing really well, when the underperformance phase comes, obviously you would have also faced a pain. Has that pain given you that rethinking, or you are quite confident that you are absolutely going to stick to your process? Market will, gradually align to maybe a equilibrium. It has moved beyond rationals. Rather than you changing your strategy, you will wait for market to come back to equilibrium.
So I genuinely believe that it is not the issue of our investment strategy. It is purely our pure execution. I don't think there is any better way to explain that. So how do we improve our execution? How do we make sure that that in terms of not missing out on an opportunity that market offers to us? I believe that there is no excuse to underperform in Indian equities, because the market is rich with investment opportunities. I mean, today those opportunities are fewer, no doubt, but they are there, and it is for us to go and find those opportunities and invest. That is what I would say. So that's why I talked about how do we improve our chances of identifying the right opportunities in a shortest period of time, and that's where the focus on further enhancing our technology expertise comes into play, and also obviously in terms of our internal processes, whatever we can do to improve our chances with respect to identifying the right names and taking them to the conclusion also plays a role.
Sure, Bhavin. I'll just move on to the last question, whereby though this could have been discussed before, but this question has come now. Does Sameeksha strictly follow bottoms up approach completely, disregarding the riding themes, or do you analyze the top down approach first, identify the macros, themes, etc., and then search out for quality investing companies with bottoms up approach?
So we actually try to combine both. When we see there is particular theme that is going to be relevant for Indian equities, we want to go and identify companies. But at the same time, we are constantly looking for bottom-up ideas, because I think that while some of the themes are very narrow in nature. So one of the stocks that has done well for us is in the digital music space, traditional music company, now digital music. It's not like you can't call it a sector theme or anything. It's just that it's a very small sector, but it's just that it happens to have very strong undercurrent. And we didn't get to that name through some kind of a top-down approach, but more of a bottom-up stock picking. And there are many such situations like that. So, but at the same time, top-down is also important. That's why I talked about identifying sectors early that might be relevant from a performance standpoint over the next 6 months and beyond. And also, so that we have enough time to work on those sectors and invest. So I think both need to be combined, and I think we'll work on that. I think I see a repeated question on one of the stocks we own, I wish not to discuss individual names like this, but anyway, it's an investment in an online stockbroker, and I think we believe in that business. I think F&O, there is a lot of fear of what regulatory backlash will be there on the F&O market. But I think that company is very strongly placed. I think they're very innovative, and I think they will find way to grow. And I think that's why we have strong faith in that company.
So you will call this company in the wealth management industry or stockbroking industry?
It's a kind of combination. I think obviously traditionally it's a stockbroking, I would say, but they also trying to build that other piece.
Sure. Because I also belong to the same industry, I know a lot of action is happening. They have been building different divisions and hiring. I understand all that. Perfect. Bhavin, I think this was a very insightful webinar. Thank you so much for your time. I also know that, you were wanting to release some note for the existing investors. So any update on that? You could give some guidance that by when do you expect to release that note to investors who really want to kind of read the first note coming to them, acknowledging, what has happened in the last 6 months and how do you think it could turn over the next 6 months to 1 year, and what to expect with a horizon of 3 to 5 years based on your past decades of experience and perspective on equity markets. We really look forward to seeing that note, and thank you so much for your time. I know that note could be coming in maybe a week's time, but I wanted to maybe give some guidance on that and maybe final remarks.
Yeah, so I think I shared whatever some of the material I shared was part of that only, but we will like to put in place some final touches and also expand a bit on some of the areas and come back to you on that. So hopefully in a couple of weeks we'll be able to release it. And final remark, obviously we are here to work and perform, and that is the only thing that excites us. We're not really looking at any kind of building a large assets under management or anything like that. And hopefully what we are doing works, and we'll have a different conversation next time.
Absolutely. Wishing you all the best. Good luck to you. Thank you everyone for joining with us today. Have a nice weekend. Thank you, Bhavin. Thanks.